Welcome to another episode. On this channel, I track my account on Wealthsimple. I currently have 3 accounts, a taxable, RSP, and a TFSA. In today's episode, I'm going to be talking about VDY, Vanguard's High Dividend Yield Index ETF, and why that is so crucial to this account. I'll be going over what is so important about VDY and what I am doing to combat this to improve my position in this ETF. So in my portfolio tracker, where I track all 3 of my portfolios, I've allocated 25% to VDY. It is currently sitting at 18.7% of my current portfolio at 76 shares, where the projected allocation should be at about 100 shares. The next largest holding sit at 5%, which is cash and various US ETFs. On this dashboard, I track my account value, cumulative dividends, and position weighting. My cumulative dividends range between $20 and $90. The account value currently sits at $17,109. I've contributed $17,500, and we are currently down about 2% overall, with a 5% yield. The average PE in this portfolio is 22, and we hold 23 holdings in total. I've created this page to record and document VDY's distributions over the last few months. These are the current distributions I have received in these accounts and the percentage of my total overall distributions I have received. So we see that VDY has ranged between 2% of my overall distributions to all the way up to 22%. This is easy to do since VDY pays monthly dividends. We can see how they change over time. They do fluctuate month to month, so they don't pay equal dividends. So currently, I have received $67 in total over the course of this account's lifetime, with an average month-over-month growth of 35%. This is very high, and I expect this to come down. If we input a growth goal, maybe 10%, we can expect an annual distribution and monthly distribution like we see down here. So we can see in December of 2022, we received $13.50. In February 2023, we can expect $16 based on this 10% month-over-month growth. And at the end of 2023, in December, we should expect $42 every month. If we pan out to annual distributions over the next 20 years, a longer time horizon, we see that these differences between each year increase. And as we get further along in our timeline, these distributions skyrocket. Now, this sort of attitude might be very ambitious, because holdings in these ETFs do change and distributions and dividends change over time. If the companies in this ETF increase their dividends, we should have a larger yield on cost, increasing these overall annual distributions over time. In 2040, we should expect $31,000 off of 10% growth goal every quarter in our VDY holdings. If we just change this by 1%, we see that the 31,000 changes to 18,000. So just 1% over the course of 20 years almost cuts in half our expected distribution. Now, we can keep to this growth goal for a certain amount of time, but in our TFSA, this will need to change just because of contribution limits. Every year, the TFSA is allocated between $5,000 and $6,500. In 2023, we are allowed to contribute $6,500 into it tax-free. And as we increase our holdings of VDY, we should eventually exceed the contribution limit in our TFSA and have to move into a taxable account, and this will change our strategy slightly. I have currently contributed $13,500 in my Wealthsimple TFSA portfolio, so we do have a lot of room to grow in this TFSA and contribute more money to. One thing we have to consider is the position sizes of VDY. I currently have an allocation of 18% with a goal of 25%. Now, the question is, can we reach our VDY growth goal while obtaining this type of allocation while also holding other companies? This is something that will need to be documented and tracked to indicate if we can continue on this trajectory of VDY's monthly 10% month over month. VDY has a 4.3% yield, and if we see some of these other companies in this portfolio, like Bell Canada and some of the banks like Bank of Nova Scotia. So this is something that does bring down the yield of the portfolio, but is not negative in the overall returns. So this chart right here is why I believe VDY is so important. If we can continually buy VDY at decent prices, we can compound our distributions over time, and eventually these distributions grow exponentially, and we can have a very good income by the end of it. Another thing I mentioned earlier was the smoothing out of distributions over time. My current VDY distributions have been sporadic, and just recently this year in 2022, I started to buy VDY on a more consistent basis, allowing it to grow month over month. We see that the expected monthly distributions grow at a more normal rate every month, and we can expect this type of chart over time. So for this year, for 2023, I have projected each month the number of shares I need to own to receive that much money in distributions. So in January, I need 99 shares, and each month it incrementally increases by about 10 to 15 shares. So by the end of the year in December, I should own 283 shares, giving us a distribution in December of $42. I've done the same for the annual projections. As each year increases, the number of shares must increase as well. This is a little bit of a different value just because of the compounding rate, since it is a quarterly compounding rate instead of the month over month average. So by 2024, we at least need to own 80 shares, and by 2030, we need 600 shares. So by having this goal of 283 shares by the end of 2023 will give us a head start on this quarterly compounding goal. Thanks for tuning into this week's episode. It would mean a lot if you liked and subscribed if you like this type of content, and stay tuned for future videos.